Welcome to the Deep Dive. We break down complex earnings calls so you don't have to.
Yeah, today we're jumping into Centerspace's Q2 2025 results. They reported August 4th, after the bell. Call was the next day.
Right. Centerspace, key player in residential REITs, and the mission today, figure out these mixed signals.
Exactly. I mean, the operations look pretty solid, right? But the stock actually dipped slightly, about 0.8%.
On heavy volume, too.
Yeah, really elevated volume. So, the question is why? Why didn't the strong performance impress the market, and what's the read-through for their strategy?
Okay, let's hit the highlights first. The results snapshot.
Sure. So core FFO, that key REIT metric, it landed at $1.28 per share.
Which was a beat, yeah.
A modest one, up just 0.8% year over year. But still, beat expectations.
Revenue.
Revenue looked good, $68.5 million. That was also above estimates, up 5.4% compared to last year. Pretty healthy growth there.
Okay, and the really core operational number, same store NOI.
Right. Net operating income for properties they've owned for a year, that grew 2.9% year over year.
Which is pretty solid. What drove that?
Well, two things mainly. Same-store revenue was up 2.7%, so they're getting more rent from existing places. And crucially, they kept expenses really tight.
The expense control.
Yeah, same-store expenses only grew 2.4%. I mean, in this environment, keeping cost growth that low, that's a real win. Helps the bottom line directly.
Okay, but there was that headline number that probably spooked some people, the GAAP EPS.
Yeah. The GAAP earnings per share showed a loss, minus $0.87 per share.
Looks terrible on the surface.
It does, but you absolutely have to look under the hood on that one. It wasn't operations.
So what was it?
It was entirely due to a non-cash impairment charge, about $14.5 million.
Non-cash, meaning just an accounting thing.
Exactly. It relates to assets they've marked as held for sale because they plan to sell them. Accounting rules say you have to adjust their value on the books now based on the expected sale price.
So it's tied to the big strategic shift they're making.
Yeah, precisely. It's the first sign on the balance sheet of this major capital recycling program they've kicked off. Core FFO excludes this kind of stuff because it's not about day-to-day operations or cash flow.
Okay, good clarification.
Yeah.
So that brings us right to that strategy pivot, capital recycling. What's the big picture there?
Well, the goal is pretty ambitious. They want to seriously upgrade the quality of their apartment portfolio by selling off some, let's say, slower growth properties, mostly in the Midwest, and buying newer, higher margin assets, focusing heavily on the Mountain West region. They think they can boost margins and get a better growth profile overall.
And they've already started executing on this.
Oh, yeah. Big time. They closed two major acquisitions in the quarter. First, Sugarmont in Salt Lake City, that's 341 units, cost $149 million, puts them squarely in a new institutional market.
Salt Lake City, okay.
And the other?
Railway Flats, that's in Loveland, Colorado. 420 homes for $132 million.
Right. And I heard something interesting about the financing on that one. You did. This is kind of a coup, really. Railway Flats came with existing long-term HUD debt that Centerspace assumed, the effective interest rate, just 3.26%.
Wow. 3.26% fixed debt in this market.
Exactly. Locking that in during 2025, I mean, that's not just good, it's fantastic for the returns on that deal. Huge value capture right there.
So that cheap debt helps. But the main strategic idea is boosting the profit margins, right?
That's the core logic, yes. Management was very clear. They expect the year one NOI margins on these new acquisitions, Sugarmont and Railway Flats, to be in the mid-60% range, maybe even pushing 70%.
And how does that compare to the properties they're selling?
It's a huge step up.
Yeah.
The portfolio they're selling, mostly in Minnesota, typically operates with NOI margins in the low 50s, so you can see the plan. Swap low 50s margin assets for mid-60s, maybe 70% margin assets. It fundamentally changes the company's profitability profile over time.
Makes sense. And the sales, the dispositions, are those moving forward?
They are. The plan is to sell 12 Minnesota communities in total, aiming for proceeds between $210 and $230 million.
Do we know the timing?
We do, mostly. The St. Cloud portfolio, that's already under a letter of intent. They expect that to close pretty soon, like September. And then 7 communities in Minneapolis are being marketed now, aiming for a Q4 close.
And the pricing seems okay.
Yeah, management sounded confident that the pricing indications they're seeing support that overall $210 to $230 million target range. So the funding side of the plan seems on track.
Okay, let's pivot back to the operations for a sec. That 2.9% same-store NOI growth, what underpinned that? How's the core business holding up?
It looks remarkably stable, actually, especially when you look at the tenant side. Occupancy is still really high, 96.1%.
That's strong. And our residents stretched.
Doesn't seem like it. The average rent-to-income ratio is still very healthy at 22.5%.
Yeah.
And bad debt, people not paying rent, is really low, around 40 basis points or 0.4%.
So tenants are generally paying on time, can afford the rent. What about rent growth on new leases and renewals?
Blended same-store leasing spreads were a positive 2.4%. That's combining new leases and renewals.
How did that break down?
New leases were up 2.1%, and renewals were a bit stronger at 2.6%. So positive, but maybe not explosive growth.
We already mentioned the expense control was good, just 2.4% growth.
Right. That operational discipline is really helping them deliver that NOI growth despite maybe moderating rent growth.
Okay, but it can't all be sunshine and roses. You mentioned mixed signals. Where are the headwinds?
Yeah. It really comes down to geography. It's like a tale of two different markets within their portfolio.
Okay.
On the one hand, there's sort of legacy markets, the tertiary ones like North Dakota, Omaha. Those are still performing really well. Strong rent growth, high occupancy. Why? Because there's basically no new apartment supply being built there to compete with them. Minneapolis is also holding up well, good absorption.
And West, where they're trying to grow.
That's where the challenge is, specifically Denver.
What's happening in Denver?
Denver is facing a lot of new supply right now, a flood of new apartment buildings opening up, and that is really hitting their ability to push rents.
How bad is it?
Well, remember that overall renewal growth was 2.6%. In Denver, renewals were barely positive, just 0.6% growth on renewals. That really dragged down the overall average.
Ouch. So the market they're pinning future growth on is currently the weakest link.
Pretty much. Management is optimistic. They talked about seeing supply taper off in Denver and job growth picking back up in maybe 2026, 2027. But right now, today, it's tough sledding there. Lots of competition. It means they might have to offer concessions, free rent to fill units.
So the timing of this pivot, maybe it's hitting a rough patch in one of the key target markets.
That seems fair to say. It makes the story a bit more complicated than just sell low margin, buy high margin. The high margin assets might take some time to really hit their stride if the local market is soft.
Which leads us directly to the guidance change. That seemed to be the main thing that hit the stock.
Absolutely. They did trim the full year core FFO guidance. The new range is $4.88 to $5 per share.
And the reason?
Primarily timing, according to management. They quantified it as about 15 cents per share of dilution for the full year, just because of the timing of these big transactions.
Okay, unpack timing for us. What does that actually mean?
Right. So think about it. They bought Sugarmont and Railway Flats. Those deals closed. So Centerspace immediately started incurring the costs, mortgage interest, property taxes, operating expenses on those new properties.
Okay.
But the cash from selling the Minnesota properties, which they'll use to pay down debt, hasn't arrived yet. That cash won't come in until September or maybe Q4.
So there's a gap. They have the costs of the new assets, but haven't gotten the proceeds from the old assets yet.
Exactly. For a few months, they're effectively carrying the costs of both, or at least more debt than they will be once the sales close. That temporary period creates this FFO dilution. It's not that the underlying business got worse, it's just the sequence of the deals.
And to manage that cash flow gap, they increased their credit line.
Yeah, they expanded their revolving credit facility by $150 million, gave them the flexibility to close the acquisitions before the disposition cash came in. It shows they prioritize getting those deals done.
But it also means taking on more debt, at least temporarily, which brings up leverage.
Definitely. Leverage is a huge focus area. Management knows that doing these deals pushed their net debt to EBITDA ratio up temporarily.
How high did it go?
They didn't give an exact peak number, but it definitely went above their comfort zone. Their stated goal is to get that metric back down into the low to mid 7x range by the end of this year, once the Minnesota sales close, and they use the cash to pay down debt.
Low to mid 7x, is that still considered high?
It's higher than their long-term goal. Their ultimate target is to get leverage down into the 5, so 5-point-something times EBITDA. But getting back to the low 7s by year-end would show they're serious about deleveraging after this strategic move.
So they took a calculated risk, levered up short-term to execute the strategy, planning to pay it down quickly.
That's the plan. They basically had to choose, wait for the sales to close, potentially missing out on those attractive acquisitions or the great debt rate, or pull the trigger on the buys and manage the temporary leverage spike.
Yeah.
They chose to act.
And the market reaction suggests maybe some nervousness about that leverage or the execution timing.
Could be part of it. Investors are definitely watching to see if they hit that year-end leverage target. It really hinges on closing those Minnesota sales on time and at the expected prices.
So zooming out, why does this whole pivot matter so much? What's the end game?
It's all about driving multiple expansion for the stock. Right now, Centerspace stock is trading at an implied cap rate. Basically, the market's expected return on the assets in the mid to high 7% range.
Which means the market thinks the assets are relatively risky or low growth, right?
Right.
A higher cap rate means a lower valuation.
Exactly. Management clearly thinks that's too cheap, especially when they can go out and sell actual physical properties, their older Minnesota assets, to institutional buyers at cap rates in the mid 5s to mid 6% range.
So there's a disconnect. The private market values their assets higher than the public stock market does.
That's the arbitrage they're trying to capture. Sell assets where the market recognizes the value, like in the mid 5s to mid 6s cap rates, and reinvest that money into these higher margin Mountain West properties that eventually they hope the market will value at a lower cap rate, meaning a higher stock price multiple.
But the market needs proof first. Proof that the strategy works, that the leverage comes down.
Correct. Execution is key. And one positive sign they mentioned on the call was that the overall transaction market for apartments seems to be thawing out. They're seeing deal volume pick up, more like pre-COVID levels. That should help them get good prices for the Minnesota sales.
Okay, fascinating stuff. Let's transition now. Time for our This Is Not Financial Advice segment. We take what we learn and spin out an outrageous but maybe plausible trade idea.
All right. Let's try it. So the core dynamic we keep coming back to is this temporary dilution, right? That 15 cents or so hit to 2025 FFO because of the deal timing.
And the temporary leverage spike that goes with it.
Yeah. Our argument is that this has created like an accidental discount on the stock. The market is dinging them for short-term noise, while the underlying value proposition is actually improving. Remember, the stock implies a mid to high 7% cap rate, but they're selling assets at mid 5s to mid 6s caps.
Okay, so the trade thesis.
The thesis is go long Centerspace. Take a bullish position now. Bet that the market, or at least the smarter money, will quickly look past this temporary 2025 dilution.
And focus instead on
the pro forma portfolio. What the company will look like after the sales close and the dust settles, higher margins, better growth profile, exposure to institutional markets like Salt Lake City.
What's the catalyst that makes this trade work? What needs to happen?
The catalyst is crystal clear. They must successfully close those Minnesota dispositions. Q3 for St. Cloud, Q4 for the Minneapolis assets. That's non-negotiable.
And when that happens?
When that cash hits the balance sheet, two things happen immediately. One, the leverage comes down sharply, addressing that key concern. Two, the temporary FFO dilution starts to reverse as they pay down debt. The earnings power starts to look cleaner.
And that should lead to the stock re-rating higher.
That's the bet. The successful execution proves the strategy is working, cleans up the balance sheet noise, and highlights the improved margin profile. We think that triggers immediate multiple expansion.
So the market stops valuing it based on the old Midwest portfolio and starts pricing in the new Mountain West reality.
Exactly. We predict a potentially rapid move toward a valuation that reflects their long-term leverage target getting into the 5x range as soon as that capital recycling is clearly executed and shows up in the year-end numbers. It's basically a bet that strategic substance will trump short-term accounting noise.
Okay, an interesting angle. So let's wrap this up. Key takeaways from Centerspace Q2.
I'd say 1, operations are solid, stable, good occupancy, decent rent collections, excellent expense control. 2, the headline, FFO guidance trim was necessary due to deal timing, not operational weakness, but it definitely spooked the market.
And 3, the big story is the ongoing strategic pivot to the Mountain West. It's designed to significantly boost margins and portfolio quality over the long run, but it comes with short-term execution risk and leverage questions.
Right. Which leads to our final provocative thought for you, the listener.
Go ahead.
Management showed they're willing to take on temporary higher leverage to make a strategic move they believe in. They want faster growth and higher margins from the Mountain West, but they also have this long-term goal of conservative leverage down in the 5x range.
So the question is,
once these big Minnesota sales close and the proceeds are in hand, what's next? Do they immediately plow that money into more acquisitions to keep accelerating the growth, potentially keeping leverage elevated? Or do they pause, prioritize hitting that 5x leverage target first, maybe de-risking the balance sheet before the next growth phase?
that tension between growth ambition and balance sheet discipline. That's the key thing to watch going forward.
Absolutely. And for broader context, we suggest you take a look at how the overall residential REIT sector ETF, that's REZ, has been performing relative to Centerspace itself. It gives you a sense of the industry trends they're navigating.
Good point. Lots to think about there. That's all for this deep dive. We'll catch you next time.